You think the economy is getting better, but the truth is you are actually getting poorer every single day because you are playing a game where the rules were written by people who want your lunch money. Look at the data right now in May 2026 and tell me if this feels normal to you. The cost of living is skyrocketing, oil is surging toward $120 a barrel because of the conflict in Iran. And while you are debating which fast food meal is still affordable, the greatest investors in history are quietly exiting the building. Before we dive into the bloodbath, I want you to do one thing for me right now. Stop what you are doing and comment your age and the exact amount you are currently investing every single month down in the comments below. Are you doing $50 a month or $5,000 a month? Be honest, because we are building a community of winners here, and transparency is the first step to escaping the rat race. If you do not have a plan, you are the plan for someone else to get rich. At some point, the stock market is going to crash. It might be caused by the bursting of the AI bubble wiping trillions of dollars of value from some of the world's largest companies. Or it starts because the Iran war escalates further, sending oil prices to their highest point in years. Add in the fact that many countries are facing a cost of living crisis with rising prices, stagnant wages, and slow growth, and you have yourself a melting pot ready to pop at any moment. Now, I am fully invested in the stock market, and I have got hundreds of thousands of dollars at stake across all of my different investing accounts. If a crash was to happen, let me share with you exactly what I would do, how I would invest, and what I would be thinking. As I am making this video, there is plenty going on in the world that has people calling for the next stock market crash. Companies are spending hundreds of billions of dollars to build new data centers and buy chips from the likes of Nvidia and AMD in the battle to win the AI arms race. These huge expenditures of real cash today have a lot of people worried about whether they will see profits anytime soon. Recently, Meta announced that they are investing up to $145 billion on AI projects in the coming year, but there is no sign yet if this will actually make them any more money. Their shares have fallen this year by around 8%, and they are one of the worst performing stocks in the Magnificent Seven. On top of everything around AI, we have obviously still got the war in Iran going on, pushing oil prices into multi-year highs. Oil reserves around the world are approaching their lowest level in years, and there is no sign at the moment that this conflict comes to any simple resolution. One day it is over, and the next day the Strait of Hormuz is closed again. These higher prices for oil are hitting some of the poorest people in the world and are causing inflation to remain higher for longer during a cost of living crisis. A market crash is something that almost every investor fears, whether you have been doing this for years or not even started yet. There seems to always be a voice from some corner of the room that any moment now a crash must be coming. Now, a stock market crash is generally defined as a decline in the market of more than 20%. Anything less than that, say around 10% or so, is typically called a pullback or a correction. Crashes are the most serious stock market event, and throughout history they have happened quite a few times. On average, you are looking at cutting stock prices by 35.8% from peak to trough, and typically they last about a year and a half. The recovery afterwards takes approximately 2 years and 2 months on average. Nobody wants to invest their hard-earned money and then just see it all disappear. It is at this point where most people end up going wrong. Picture this: everyone around us says the market is going to crash. They point to all of the data and say that a market crash is due anytime. Now, our normal human response is to go into protection mode. If a crash starts and we see red days, we start to worry and think we better get out as soon as possible. We save what we have, take the profits, and hold on to our cash. We might even buy things like gold or bonds. All of that sounds perfectly normal and rational. Stock crashes are bad, so let us just avoid them and only invest when times are good. Oh, how I wish investing was just that easy. But this is not how the market works. In order for that plan to work, you would have to have some kind of amazing crystal ball. You would have to know a crash was about to come and sell out just before. Then you would need to know how long it was going to last. Then you would have to time your new purchase right at the bottom, which is typically when fear is at its highest point. There has been nobody in history who has ever done this on any kind of consistent basis. Sure, Michael Burry predicted the global financial crisis, but for every right call, there are literally thousands of wrong ones. Look at fund manager John Hussman. He predicted the dot-com bubble and the 2008 crash. He got billions of dollars in his fund. But then he kept betting against the market during the longest bull market in history. Over the last 10 years, his fund has returned a negative 2.7% a year. His investors lost money and paid high fees for supposed insights. There is nobody that can predict when a stock market crash can happen. You cannot predict the future moves regardless of how intelligent you are. So, where does that leave us? Nobody knows what will happen, and that is part of investing. That is why investors receive returns in the first place. We put our money into shares with the hope they rise in value over the long term, with absolutely no guarantees. With no risk comes no reward. When we invest, we need to expect that prices are going to change every single day. Look, $1 million is the universal retirement number, and we are going to get there in this video. 3 completely different ways. The question is, how much would you actually need to invest every single day to make it happen in just 10 years? Most people guess way off, some way too high, some way too low. The real number is the kind of thing that changes how you think about almost every other financial decision you make. We are going to find that number 3 different ways. In this video, we are going to walk through 3 Fidelity Index Fund portfolios. One built for 30 years, one for 20, and one for 10. All 3 start from $0. All 3 end at the same $1 million finish line. For each portfolio, you will see the exact funds, how much goes into each one, and what the balance looks like year by year. And in the end, I will show you how to reach $1 million in just 10 years. But before we get to any of those daily numbers, let us start with the destination. Why $1 million? And what does it actually do for you once you get there? Let us say you have nothing saved for retirement, not a single dollar. You work a regular job, make a regular income, and until about a week ago, you were pretty sure retirement was something that happened to other people. Then you ran the numbers. The number everyone talks about is $1 million. And there is a reason for that. There is a retirement strategy called the 4% rule, backed by decades of research. The idea is simple. If you have $1 million invested in an index fund portfolio, you can pull out 4% of it in your first year of retirement. That is $40,000 money you did not have to work for. The next year, you adjust slightly up for inflation and you do it again year after year. The reason this works without draining the account is because the market typically grows faster than 4%. So while you pull out $40,000 a year to live on, the portfolio is still growing in the background. The principal usually stays intact, and in a lot of cases, the account actually keeps getting bigger while you spend from it. $40,000 a year breaks down to $3,333 going into your account every single month, whether you work or not. Add the average Social Security check on top of that, about $2,076 a month, and you are looking at over $5,400 a month in retirement income. So $1 million is the destination. The question is how to get there from zero, and the answer depends almost entirely on something you haven't decided yet. How much time you are willing to give it, and no matter which timeline you pick, the funds you use are the same. So let us look at the 3 we are working with. The 3 funds are all from Fidelity. One you have definitely heard of, one you might have heard of, and one that is about to surprise you. The first is FXX, the Fidelity 500 Index Fund. It is the biggest, most boring fund in the portfolio, and that is exactly why it works. FXX tracks the S&P 500, the 500 largest companies in the US. So when you buy it, you are basically buying a slice of the American economy expense. Ratio is 0.015%, which is about as close to free as investing gets. Over the last 10 years, it has averaged about 12.97% in annual share price appreciation. That is the foundation. The second is FNCMX, the Fidelity Nasdaq Composite Index Fund. This one tilts towards growth instead of the S&P 500. It tracks the entire Nasdaq, heavier on tech, biotech, the kind of companies that grow faster but also swing harder. Over the last 10 years, FNCMX has averaged about 16.91% in annual appreciation, higher reward, higher volatility, the bridge between safe and aggressive. And finally, there is FELX, the Fidelity Select Semiconductors portfolio. This is the wild card. It only invests in semiconductor companies. The chip makers behind every phone, every laptop, every AI model. Over the last 10 years, FELX has averaged 22.04% in annual appreciation. That is not a typo. It is also the riskiest fund in this video. Semiconductors are cyclical, which means when they crash hard. But for the right portfolio on the right timeline, FELX is the engine that makes a 10-year retirement actually possible. Okay, so those are the 3 funds. Now, let us see how we actually use them. We are going to start with the easiest version first, the longest timeline, 30 years. The reason is simple. When you have that much time on your side, the math does most of the work for you. So the portfolio does not need to take much risk. Here is how it breaks down. 60% in FXX, 30% in FNCMX, and just 10% in FELX. The broad market does the heavy lifting. The Nasdaq adds some growth, and the semiconductors are there for a small kick of upside without taking the whole portfolio off course. Blend these 3 together, and what you get is a portfolio with a 0.81% dividend yield, a 6.18% dividend growth rate, and an annual share price appreciation of just over 15%. The dividend yield is huge, but with 30 years to compound, it really doesn't need to be. The 15% appreciation is doing the heavy lifting, so how much do you actually have to invest to make this work? $6 a day. That is it. $6 a day, about the cost of a coffee and a bagel. And here is what happens to that. $6 a day, by the end of year 1, the account sits at $2,190. Basically what was put in. By year 10, that account is projected to be at $45,641. By year 20, it is $234,158. And by the end of year 30, the day you retire, that account is worth $1,004,50. A little over $1 million from $6 a day. And remember, at $1 million, that account starts paying you $3,333 every single month for the rest of your life if you use the 4% rule. All from a daily contribution roughly the price of breakfast. But here's the part that matters most. Of the $1 $100,450 in the account. You actually contributed only $65,700 of your own money. The other $938,450 was the market doing what the market does over a long enough timeline. That is the thing about 30 years. You are not really the one building the wealth. You are just the one who showed up consistently. The compounding does all the work as long as you give it the time. But here's the thing. Most people watching this do not actually have 30 years to give. So, what happens when you cut compounding runway by a third? One plan down, two to go. And in the end, I will show you how to reach $1 million in just 10 years. But first, let us look at the 20-year portfolio. For this, we use the same three Fidelity funds FXX, FNCMX, and FELX, but now the weights shift. FXX drops from 60% down to 35%. FNCMX moves up to 40%. It is now the largest piece of the portfolio, and FELX more than doubles from 10% to 25%. The reason is straightforward. With less time on your side, you need the portfolio to grow faster. So, the broad market shrinks and the more aggressive funds take over more of the workload. The new portfolio comes out to a 0.58%. Blended dividend yield, a 5.16% dividend growth rate, and an annual share price appreciation of about 16.81%. The yield drops, the dividend growth drops, but the appreciation climbs, which is exactly the trade you are making. Now, here is the daily number: $22 a day. Almost 4 times what the 30-year version cost, about $660 a month, $8,030 a year. That is still a doable number for a lot of people watching this. It is a couple of skipped restaurant meals, a smaller car payment, or the streaming subscriptions nobody really uses, but it is a real number that demands a level of discipline that the 30-year plan does not. And here's how it grows. By the end of year 1, the account is at $8,030. By year 10, it is projected to reach $180,684. And by year 20, exactly 10 years earlier than the first plan, that account hits $104,0920. Same finish line, same $1 million portfolio, but notice what shifted. In the 30-year version, you contributed $65,700 of your own money. In the 20-year version, you contributed $160,600 of your own money, almost 2.5 times more. The market still does most of the work, but a much bigger share than the last version of that final $1 million came directly out of your pocket. You bought 10 years of time back, and the price was about $95,000 extra out of your own paycheck. Now we get to the version most people click this video for, the 10-year version, the one the title promised, the one that turns $0 into $108,3634 in just a decade. And yes, it is going to cost a lot more than $22 a day. But before I show you the math, I need to be honest with you for a second. The 10-year plan is the most aggressive version of this video, and it is not for everyone. Let me show you the actual math so you can decide for yourself. Here is the portfolio. FXX drops all the way down to just 15%. FNCMX sits at 35%. And FELX, the semiconductor fund, takes the largest position at 50%. Half the portfolio is now in a single sector that is a concentrated bet on growth. The reason is the same reason that has been true the whole video. With only 10 years to compound, the broad market alone isn't going to get you to $1 million. The portfolio needs to grow at a rate that the broad market just cannot deliver inside a decade. So the aggression level doubles. The blended numbers reflect that. The dividend yield drops to 0.34%. The dividend growth rate drops to 3.44%. But the share price appreciation jumps to 18.88%. The highest of all three portfolios, and the daily contribution. Brace yourself. $120 a day, $43,800 a year, about $3,650 a month every month for 10 years straight. To pull that off, you are realistically looking at a household income somewhere around $120,000 a year. Because below that, $3,650 a month into investments isn't a realistic ask after rent, groceries, and the rest of life. If that is not where you are at, the 30-year or 20-year plan is the version that best fits you. That is not a downgrade. That is just what math allows. But for the people who can do it, here is what it builds. By the end of year 1, the account is at $43,800. Basically all your own money, since the market hasn't had time to do anything yet. By year 5, that account is projected to reach $320,168 with the market, now adding meaningfully on top of your daily contributions. And by the end of year 10, the account is worth $108,3634. Of that $108,3634 in the account, you personally contributed $438,000. The market added $645,634. The market is still doing more of the work here, but barely. You write a check for almost $500,000. The market still adds more, but the gap is almost gone. You are matching it nearly dollar for dollar. That is the price of cutting compounding runway down to a decade. You can do it, but you are paying for the time you did not give it. Now here's where